Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. So today we continue to get action that leads us to believe that there's a wedge pattern building in the upper level of the market as we digest some of the recent action that we've seen. We had a big, obviously, rally to start 2013. We've had that melt-up type action, and right now I think traders are welcoming a little bit of that more volatility, some gap downs that have been able to be bought, some gap ups that have been able to be sold. It's a little something different, that it's a little bit more tradable action in the short term, but on a more macro basis, like I said, it feels like we're going to build an upper range, an upper level wedge, and until that happens, I think this is an environment where you take trades a little bit more quickly, or you just sit by and abide by your long-term approach that you might have with some longer-term swing trades or some long-term investments. If we go take a look at the chart of the spiders here, you can see that wedge pattern that we've been talking about in the upper levels here. After that big outside day last Wednesday that everyone talked about, it wasn't a big down day percentage-wise from open to close, but we closed about 2% off of our highs of that day. Obviously a very loud reversal signal. If you read any stock market trading blogs, everybody was talking about it, everybody was writing about it. But the question was, what is it going to lead to? And right now, I'll draw this wedge pattern for you. This is even from that most recent breakout, that gap and go. And then you see the top end of that trend line right here. So I think until we get a little bit more rest, a little bit more consolidation, a little bit more of that wedging type action, we won't get our next leg lower or higher. I think it is a natural thing right now, especially after Memorial Day as we head into the summer months, to expect more quiet, range-bound type action, and I think that's going to be continue to be what we see. But despite that, we do continue to see nice movement in individual names. Because of some of the stocks with high short floats have had such large moves and this big erratic action, there does continue to be a group of stocks that remains very much in play from a short-term trading perspective, despite the fact that the market could quiet down a little bit and start to trade in a little bit of a range. And like I started with yesterday, when you start talking about that group of volatile stocks that active traders are really pouncing on and riding right now until that volatility dries up, you have to start with Tesla. We'll go ahead and get off our line tool, take a look at the chart of Tesla. And today, a little bit of different story than yesterday. Obviously, yesterday you had that big extension, continue to squeeze shorts. There's no telling how far those squeezes can go, but what you look for is a calculated reversal signal. And Scott talks about his red dog reversal. It's just basically a strategy that when a stock trades through the previous day's high and then back below it, that can trigger a calculated short entry where you place your stops on that trade at the high of today. So for example, yesterday's high was 110.75. Once we traded back through yesterday's high, that could have triggered your short entry, and you could have placed your stops on that trade at today's high of 114.90. That's a decent amount of pain, but for some potentially really nice reward, you could actually even tighten up your stops on that a little bit. If it does trade back above yesterday's high, it generally is an indication that that big downside is not coming. But during the session today, we got big time downside in Tesla. It had engulfed yesterday's entire candlestick at one point. It was able to bounce nicely into the close. We're going to take a look at the 34-minute chart, a nice proprietary time frame that some of our guys look at here that we have saved on our e-signal. And you can see that action this morning. After a small push right off the open, you got a big downside cascading action in Tesla. There was some speculation that David Einhorn, the famed short seller, could potentially be targeting Tesla as one of his next big shorts. You saw a big time downside, 15-point drop in Tesla in about 90 minutes there, but it was able to bounce into the close. I know Mark was nibbling on it near the lows here. I think he entered on the VTF around 101. So a nice job buying the dip there on this very volatile stock. But I think right now, I'll go back to the daily chart. This is one that if you're a very skilled short-term trader, this is volatility that you can't ignore, and I think you continue to pay attention to it and trade short-term patterns and price action. But from a macro perspective, I think it's run too far to buy it here and put it in the drawer. But I also think it's very dangerous to put on swing shorts because of that high short interest and the potential for big squeezes and new product launches and much ballyhooed tweets from the famous Elon Musk now, who's the man of the hour. And like we did yesterday, we'll stick with the Musk theme and go straight over to SolarCity, Elon Musk's other venture in the solar sector. That one quieted down a little bit today. I mean, it still had a large percentage move, but relative to the recent volatility, it was somewhat quiet. But it was able to find its footing. It's still holding above the 8-day moving average. So even though this is another one, I think fundamentally things have gotten out of whack. I think fundamentals aren't driving this trade right now. And if we do get an upper level consolidation, despite yesterday's large down move, I do think with another upper level base or wedge, we could get another squeeze in SolarCity. I mean, it has come a long way, but you see where Tesla came from, and you look at the chart of SolarCity, and it doesn't even seem like that crazy of a move. You draw your lines up here. Who knows where this could go with a really heavy short interest and all that type of stuff in play. Yesterday's down move might have gotten some people chasing the short, and those people could be ready to be squeezed, but definitely another one to keep an eye on. I know Mike Lee, Steve LeVay in the Momentum chat room on T3 Live will definitely be keeping an eye on that one. And we will take a look at a couple other stocks today that we talked about yesterday. LinkedIn is one that I've been talking about on the site, in our articles, in the morning note, on Twitter, as one that I think is a really ripe short setup. And yesterday we got a break above sort of this first floor up here. We got a break below this floor. The low was 170.80. So that was your trigger yesterday short on that trade. And then we have another pivot level here back from early April. The low of that candle is about 165. So today we probed that a little bit. The low of the day today was 164.17. So we did briefly dip below that and didn't trigger any more downside. I think after the recent weakness in LinkedIn, now it's a little bit extended down below its 8 and 21-day moving averages. I think it might be healthy to see LinkedIn. When I say healthy, I mean healthy if you're looking on the short side. It might be good to see LinkedIn rest a little bit, digest some of this recent downside, let those curling moving averages catch up, and then look for another short trade in LinkedIn. But I do think the narrative fundamentally has changed on this after it missed on its most recent earnings report. And I think technically it's looking toppy with a little bit of a rounded top after it tried to break out ahead of its most recent earnings. I really wouldn't be surprised to see LinkedIn back in the $140 area. And even this gap, I think, around 125 is going to be in jeopardy on a longer-term basis. You've seen some really volatile movement in a lot of these stocks, and I hate to be too ambitious calling out a short setup in LinkedIn, but I do think this is one that really is ripe for a lot of downside. And I think people are much more interested in taking profits and shorting this name than they are in chasing it higher. Another name, this is two names today that have obviously been in the news over the last several years, but people sort of, I think, forgot that they existed, were Fannie Mae and Freddie Mac. Those today, they've been on a really strong run the past several sessions, as there's been talk about settlements and some lawsuits that were still pending with them. But today they saw really wild, volatile action, initially surging very strongly on reports of a settlement with Citigroup relating to their mortgage issues during the financial crisis. But there was additional talk about the possibility of, as a part of some financial reform and mortgage reform, that there could be a push to wind down Fannie Mae and Freddie Mac and dissolve them. And I think some of that talk weighed on a lot of those two stocks today. We'll go ahead and take a look at the chart of Fannie Mae. Wrong symbol, FMN. What is it? FNMA. Sorry about that, guys. Fannie Mae, let me look at that huge volatility today. The stock was in the doldrums. It got basically taken over by the government. Then the stock was able to rally, and then over the past 7 sessions, been on a monster run. And when you talk about parabolic, this is your definition of parabolic. You see, obviously, that pattern forming. It stretched out here to almost 550 today after trading under $1 in early May. And then obviously you saw that huge volatility. This is one that I would stay away from. It's an OTC stock, but just important to note that volatility today. And then you look at FMCC, very similar type thing. Freddie Mac, huge volatility today. Just something to keep an eye on, to note in the market, but not something that I will ever touch with a 10-foot pole. Coors today, big winner, and has a really constructive looking pattern. This is one that, new IPOs are sometimes the biggest winners in a market. You zoom out a little bit, as you see Coors stocks. We like to trade stocks that were really successful on their IPO and continue to build patterns over the course of their public life. And you go back, you look, Coors IPO'd back in 2012. Take a look at a weekly chart on Coors. You get a little bit of a long-term look. Obviously really strong following the IPO, doubled in price within a few months, built a nice descending channel flag type pattern, erupted out of that one, built another flag. Looked like it was going to break out of that one, but sort of had a king and queen looking candlestick formation there. Another descending channel is breaking out of, and now looks like it has a little bit of a cup forming. Maybe you could see a handle form. We go to the daily chart, and you can see maybe a little bit of a handle is forming on the daily chart. You have a nice rounded bottom. It bounced off his 200-day moving average. You had a nice little consolidation here. It looked like it might try to break below on that market weakness, but then today very strong on nice volume. And the stock looks potentially poised for 52-week highs, I think, all-time highs for Coors. I know my girlfriend really likes Michael Kors. I've never really had any of their stuff, but I think it seems to be a popular brand, and the stock reflects that. But Facebook, on the flip side of things, is one that continues to just be an absolute dog. Is that this stock has been mentioned. You know, Scott's mentioned it a few times. I know Kramer highlighted his call on it. You know, based on the technicals, the fundamentals of Facebook haven't ever really been that compelling. They struggle on mobile, which is a very important thing for social networks and mobile-driven businesses, but their mobile advertising has never been great. People thought that perhaps on this most recent earnings report they showed some decent growth in that area, but it's not been enough to trigger any longer term and what would seem to be institutional type buying, and Facebook continues to just bleed lower. And you start to go back and you have to look at levels from 2012 to talk about support for Facebook. And to be honest, there's not a lot. I mean, down here you could talk about maybe this little cluster right here providing some support in the 2250 area. But ultimately, there's really not a lot of support until you get down here at lows. That's another ambitious target. I don't know if Facebook will get all the way back down there again, but this is one that I've talked about before on videos that I've done, is that obviously a lot of people use Facebook. It's a very popular social media site, but in terms of its ability to make money and its the fact that it's very ripe for competition in that social media sector, this is never a stock that I would be interested in owning long term. This is not a sector that I'm looking to put money away into individual names long term. I think they're very speculative. You talk about LinkedIn, you talk about Facebook. LinkedIn has a more solid business model. I think the stock price action reflects that, but especially Facebook, I think, is becoming even more overridden with ads, and apparently those ads aren't doing enough to make the company money to make it very worth it. But I think I'm getting turned off by using Facebook just anecdotally. I think the stock is reflective of the fact that a lot of people are skeptical about the future of Facebook, both from a user perspective and from a financial perspective, and it's not one that I would be looking to catch this falling knife on. We continue down the list. The ags were very strong today. We take a look, we'll start with CF, one of the more volatile names in the group that has been a little bit of a dog more of late. We'll zoom out a little bit so you can get a longer look at that chart. Everybody was in love with the ag sector. I know Jill Malandrino from the Street Options Profits will come in here often and extol the virtues of the ag sector, and I largely agree with her. I think the ag story long term is a bullish one as world population grows and the affluence of that world population grows, and as people, for example, it takes more corn to feed cows to eat red meat than it does just to eat the corn. And when the affluence of world population grows, you have more people eating red meat and eating more things that are higher up on the food chain. A little story there for you. But anyways, I'll get back to the price action. CF is below its 200-day moving average still, but it's now found some support with its 8 and 21-day moving average. Looks like it might have found its footing a little bit. Like I said, long term, I think this is a winning story. And for a short-term entry signal, you just have to have the technicals sort of agree with that thesis. And I think right now you're seeing a little bit of a perk up in these ags, these fertilizer stocks. And I think if it can get above this pivot here around 196 to 198-ish area, I think you could get some more momentum. And I think you could quickly see CF back in this $210 area. A couple other names in that sector, AGU, strong day today. In the context of this bigger down move, today wasn't a monster move, but I do think it's another one that we talk about. If it can get up to this $95 pivot and break above, you could see it reclaim its 200-day moving average, potentially get back up, into the $100 area pretty quickly, in my opinion. Mosaic, another one, really strong day in the sector. This is one that I know Scott highlighted in his 2013 thesis, and one that Jill Malandrino has talked a lot about, being very positive about. if you want to play relative strength in this fertilizer agricultural group, this is one that's above its 200-day moving average and above all of its short-term moving averages. So this is one that if you want to play one of the stronger names rather than looking for value in one that sold off a little bit more, a Mosaic is the play for you, and I think it could break back out again fairly quickly if this sector stays in vogue after today's strength. We'll take a look at the banks really quickly. They were strong today. They've actually been strong the last 2 days. Yesterday on the gap up, they were able to hold more of the gap, and they gapped bigger than a lot of other stocks, which tells you that perhaps the banks aren't ready to break down yet. I said in an earlier video a couple days ago, sometime in the middle of last week, about how I think, maybe it was on Twitter, that I think if the market does weaken and we do get a broader correction than we've seen in 2013 so far, the banks are a sector that I would really look to for downside. But as long as the market holds up, and right now it's holding up in that upper level wedge pattern, I think the banks could continue to provide some leadership and perform well. But in a market correction, I think the banks would be vulnerable. But for right now, the jury's out on whether that correction's coming. So I think you can stick with the names and continue to follow the price action. I had the chart of Goldman up right there. When we go back to the charts, it was strong today. I'm still not in love with Goldman. I do think it's one of the best in breed banks. But in terms of the way the stock has been acting, I haven't been in love with it. I think you can get some more value with a name like Citigroup. It started to show relative strength after a nice earnings report this most recent quarter. It started to lead the group. And I think if it can break above this pivot, I think maybe you get some more bang for your buck with Citigroup. I also like JP Morgan in terms of the quality of the institution. I think JP Morgan is up there with Goldman Sachs perhaps as the best financial institutions, most trustworthy in terms of being able to trust their financial performance and the fact that they'll continue to lead the sector. They've got all that Jamie Dimon stuff, it seems, out of the way. You could have got a nice discount on the stock, I think, if you just believed all along that he wasn't going anywhere. But that's obviously tough to do. You don't want to play that speculative game. But JP Morgan's strong within the sector. I think it's one of the ones that I would be looking to buy. Look at a couple other things to round things out. The TLT, we talked about bonds, the potential for the great rotation. I highlighted that potential head and shoulders pattern that could be forming in the TLT yesterday. I'm not completely sold on that. The pattern definitely suggests that could be coming, but I would be a little bit cautious on that. I think there's a lot of macro forces at hand that may continue to support that bond bubble, but we'll continue to obey the price action on that until we get a break of that neckline of that head and shoulders pattern. I think this is something that you watch more than you trade. I don't know if I would trade TLT or trade TBT, but it's something I would keep an eye on as a signal for the broader market. Yesterday, for example, you got a huge sell-off in the bonds. The market wasn't able to rally in conjunction with that sell-off, so that could be a red flag for you if you're looking for bearish arguments on the market. We'll also take a look at gold, and we'll actually take a look at the gold miners in a second when they were a lot more significant today. Gold was able to bounce a little bit today after yesterday's gap down and very volatile day yesterday. It put in some big tails. Gold was just up a little bit today, but you look at the gold miners ETF, GDX was up around 4%, showing a little bit of strength ahead of the underlying asset. So that's maybe something to take note of. And if it can break above this pivot here, which it sort of probed today, the high is 28.66. Maybe it gets a little bit more momentum and gets back up into this $30 range. Long term, I am bearish on gold miners, on all that type of stuff. I don't believe it's a compelling story, especially with the Fed changing their rhetoric and all that type of stuff. But maybe you could get a short-term bounce if you're looking to be an active trader in gold miners. The last thing we'll talk about in the commodity space is oil. We'll take a look at USO just sort of as a proxy for oil. Oil was very weak today. Yesterday it was strong, gapping up and holding most of that gap. USO sort of got rejected at that $34 area, but today gave back all those gains and more. And commodities continue to be weak. That's a theme of 2013. In the face of a strong market, commodities have underperformed. Just something to keep an eye on, something to note, and that's about it. I don't trade oil. I don't trade commodities too much. But this has been John Darsie here for your daily recap. Today was a little bit of a quiet day. We continue to build that upper level wedge pattern. Just walking around the trading floor today, you hear a lot of guys talking about potentially taking Friday off and and stuff like that. And you don't start to hear that type of stuff if there's really a lot of opportunity out there in the market. I think a lot of guys right now are making the judgment that it's been a busy start to the year. There's been opportunities in individual names, and obviously the market's been melting up, but they see things sort of quieting down a little bit from a stock-specific and a broader market perspective, and especially as we get into the summer months, as we start to have a little bit more range-bound trading than we've seen for most of this year. That could be a cue to pare down your risk a little bit if you're a short-term guy. And if you're a long-term guy or gal, there's no reason to really change what your focus has been. But we'll see you back here for the morning call and the morning note tomorrow morning if you're on that free distribution list. We'll see you tomorrow.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
I'm Mark Spur.